Hello, everyone, and welcome. I'm just going to let everybody take a moment to join the webinar. So we're going to give everyone a minute and a half just to come into the room. While we do that, I'm going to do some introduction and housekeeping, and we'll get started right away. So good morning. I am Linda Griffian, the Education Programs Coordinator with BusinessLink, and thank you for joining the webinar today. At BusinessLink, we are honored to provide services to all entrepreneurs and specialty services to our immigrant and Indigenous entrepreneurs. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations group, Métis, and Indigenous people whose ancestors have walked this land since time immemorial and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. A couple of housekeeping notes today. If you have burning questions, you are welcome to ask them. You can use the Q&A box at the bottom of your screen. I know our speaker today is going to engage you in the chat box as well, so be prepared to answer some questions from her in chat or to introduce yourself as you come into the room. Today, Vanessa Brown is going to be presenting advanced financial statements. While she does that, I'll be posting a link to the handouts for today's session in the chat box. And without further ado, Vanessa, welcome, and please feel free to introduce yourself and get us all started.
Good morning, everyone. My name is Vanessa Brown. I am a CPA, and I've been practicing accounting for 28 years. I work with small business owners and mostly the shareholders of small businesses that have revenues of 15 million or less. Lots of startups, lots of entrepreneurs, and I also deal with their tax planning needs from their trust and estate type work. It is a pleasure to be here today with BusinessLink, and I hope this presentation will help you to learn more about the complex concepts of financial statements, such as accrued payables, work in progress, and non-operating income. We have about an hour together today, and Linda will make sure that you get a copy of the presentation and some additional notes. The session is designed to be as interactive as Zoom will allow, so that will be through the chat. So you can feel free, you'd ask questions through Q&A, and I'm going to ask you a few questions to answer in the chat. So do please just put those questions forward, and I will answer them mostly at the end of the session, unless I happen to catch something during the session. I will have about 5 to 10 minutes at the end of the presentation to field any of those questions that I didn't address throughout. If there's any follow-up questions that we don't get to today, my contact information is on the website. That's my website, www.vabrown.ca. And on the website are some links to contact me with my email and my phone number. So before we get going, in the chat, if you can tell me 4 things about yourself. You don't have to disclose the business that you work for, but I'm wanting to know what your role in the organization is. So are you, the bookkeeper? Are you the business owner, etc.? And anything about your background that might be helpful. I would like to know the size of your organization, either in terms of number of employees or gross revenues, annual gross revenues, if you're comfortable sharing that. What industry your business is in, and then what you would like to learn from the session. So 4 things: your role, the size of your organization, the industry, and what you would like to get from the session. So in this presentation, we're going to answer some of these questions. These are common questions that business owners ask on a regular basis. How are cash and accrual accounting different? Why is my balance sheet so complicated? A lot of business owners really focus on their income statement without understanding that the balance sheet, if not accurate, if not being looked at, the adjustments to the balance sheet can affect the income statement significantly. So you need to take a look at the balance sheet and get an understanding of why it might look more complicated than you might expect. We're going to talk a bit about depreciation or amortization of assets. We will talk a little bit about prepaid expenses and talk some about intangible assets. A topic I deal with regularly with business owners is what are retained earnings? What is that number? We will talk about how earnings per share is determined, and we will discuss some non-operating income items. So when we look at the income statement, we're going to segregate between operating expenses and non-operating expenses. So the first thing that makes financial statements a bit more complex to the business owner is that cash accounting. A lot of business owners initially, when they start out business, think about everything in terms of just the cash transactions. So cash accounting, cash basis accounting, is recording transactions only as they've gone through the bank account. Accrual accounting, which is where we want all business owners to be at, because this is a little more comprehensive, is we would recognize transactions when they occur, not necessarily when the cash is received or the cash is paid. So sales will be recorded at the time the invoice is, and I wouldn't even say the invoice is issued. We would record sales when substantial completion of that revenue has happened. So if we've delivered goods to somebody, we want to recognize the sales when they've been delivered, not necessarily when the invoice is issued, because sometimes there can be a delay in the issuance of the invoice. We would also record expenses as they are incurred, not when they were paid. And so some industries do have up to 30 or 60 days, occasionally 90 days, between the delivery of the goods and when payment is received or payment is made. So we want to record in the accounting records the transactions as they've occurred, not when the cash is received. This gives us a better understanding of where the business is at a specific date. There are some small businesses, these would be sole proprietorships, that for tax purposes are allowed to use cash basis accounting. It typically isn't recommended. And also when you have a corporation, from a tax perspective, you have an obligation to start with GAAP income. Now, most business owners are not having GAAP financial statements, so we call it kind of GAAP-ish. And definitely using accrual accounting. Here's an example of a very basic balance sheet. We have total assets of $100,000. The breakout is 60,000 current assets and 40,000 of fixed assets. And then we have the liabilities and owner's equity, which also equals the 100,000. As we go through the examples, this balance sheet is going to get more and more complex. This one's very basic. It's got cash, a little bit of inventory. It's not complex inventory. We're going to make some complexities in that. The accounts receivable, and then we have property, plant, and equipment, less the depreciation, accumulated depreciation. So that's depreciation on those assets since they were originally acquired, not just the depreciation for the current year. We have some accounts payable. We have a bank loan payable, and notice that the bank loan is split up between short-term and long-term. And we have some capital stock, which is the issuance of shares to the owners, and some retained earnings. So what could make the financial statements a little bit more complex? Well, we instead of having just one category of inventory, we can have raw materials, work in progress, and the third category would be finished goods. An industry example would be say a builder or developer, let's go with a builder of real estate. They would have raw materials in the form of lumber and shingles and drywall, etc. They will have work in progress, which will be a few properties that are currently being constructed. Then they will also have finished goods. So they will have a few houses that are already done, available for sale, and have not yet transacted to a future buyer. Some other complexities, prepaid expenses. So items that maybe get paid once a year that are for the whole entire year, we will prorate and include as an asset the portion that is not yet used of that. So let's look at insurance. Might pay insurance once a year. If we have a year end that's December and we paid the insurance in June, we would by December still have 6 months of insurance that's not yet used up. And so we would record that as a prepaid expense. We have depreciation, which is our acknowledgement of the use of a fixed asset. So let's say we have a piece of equipment that we use in some manufacturing, and we expect that that piece of equipment will continue being useful in our manufacturing operation for, say, 8 years. We would depreciate that asset over 8 years. We would expense a portion of it each of the 8 years. It might be straight line if we think we're going to use that piece of equipment equally over the 8 years, or it might be some form of declining balance or use based on the number of widgets we produce each year to acknowledge the difference in use year to year. So if it's not expected to be equal over time, we would maybe depreciate 50% of it in the first year because we manufacture a lot of widgets that first year, and then the next 7 years, just a little bit. Don't know. We have to try and estimate that to the best of our ability. The intangible assets that we can have are goodwill. So if I see some of you are owners, you might have purchased your business from someone else, and what was not, what portion of that payment was made to the prior owner that was not directly attributable to a customer list or a fixed asset would be acknowledged as goodwill. Other intangible assets can include the customer list and can include trademarks and patents. Liabilities that make for some complexities are accounts payable, accrued expenses. Those are a little different than accounts payable. An accounts payable is when you've received goods and received the invoice from the vendor. An accrued expense would be something that relates to the current year, but you don't even know what exactly that amount is until after year end. Common accrued expense for small business owners is their accounting fee. So the accounting is generally done 2 to 3 months after the year end. That's when the finalized financial statements are done, the tax returns are filed. There's been time to analyze all of the accounts and make them accurate as at year end, do the adjusting journal entries. So we will accrue that expense because it relates to the year end, but is not a known amount until 2 to 3 months after the year end, and that's when it gets invoiced and paid.
Oh, I don't know where I'm sitting today, sorry.
Payroll taxes payable is another item that can add complexity. So this includes remittances for the year that are not made until 15 or 30 days after the year end. It can also include vacation payable to any employees that don't get their vacation paid on each and every pay. And then there's loans payable. And if it's a longer term loan, we will be segregating the current portion due within the next 12 months and also the longer term portion. So you'll see the bank loan in 2 spots. And then there's retained earnings, which is exactly what it's called. It's the earnings that have been retained in the business. So over time, the accumulated income is what we call retained earnings. And it's the accumulated income that was not paid out to shareholders as a dividend. So here's a more complex balance sheet. So now we see cash. Instead of just one inventory item, we see three: raw materials, work in progress, and finished goods. We still have the accounts receivable, and then we have this prepaid expense on there, which is new from and different from the basic one we saw earlier. We have the property and equipment and the accumulated depreciation as well, and now we have a goodwill item. On the liability side, still have the accounts payable, but now we have the accrued expenses. We have some payroll taxes payable. And again, we have the current portion of the bank loan and the long-term portion of the bank loan. Again, this current portion is the amount that is due within the next 12 months. Sometimes that can be due within an operating cycle. So in my example of a builder, I'll say a developer, because a developer would have a longer cycle. It might be an 18-month operating cycle, not 12 months. And so we might have 18 months in a current portion, might extend longer than 12 years, just depending on, there's 12 months, depending on the industry. And then we still had the capital stock and the retained earnings. So now this balance sheet totals, the assets are 130,000 and the liabilities and equity are also 130. Should always balance like that. So we will be using this balance sheet when we discuss for the remainder of the session. So a business like a retailer, so something like a clothes seller, they might only have one type of inventory because they buy finished goods from a designer who manufactures the clothes. So they buy the finished product and they have only just one inventory item. But a manufacturing company or a manufacturing company will always have these other two categories. Also, professionals such as lawyers, engineers, they might not have the raw materials inventory because they're not manufacturing a product, but they will have work in progress. And the tax rules require that the work in progress is acknowledged. So this would be time spent on client files that had not yet been invoiced by the year end. We have to make an estimate of what that is. So let's say there was a job that had been quoted for $10,000 and the work in progress, we'd finish 75% of that $10,000 job by year end. Even though we had not invoiced for it, we would record the work in progress of $7,500. The 10,000 total project multiplied by the percentage that was complete by year end, so 7,500. And then in the manufacturing industry, they would have the finished goods inventory. This is the things that had been completed, but not yet sold to a vendor as at year end. The significance of these different categories is more from the bank perspective. So if the business is financed by some bank loans, the bank will likely require financial statements, either monthly or quarterly, and they'll want to know these different categories because let's say that raw materials was really high and very little in work in progress and finished goods inventory. They would be interested to know how long it takes for those raw materials to be converted, because the business will only be able to make a sale and therefore get cash inflow when they have finished goods inventory to sell to a third party. All these other are steps to getting there. Now, prepaid expenses, the typical ones we see are insurance, paid once a year. Some businesses pay it monthly, usually cost them a little bit more throughout the year, but then it doesn't require the finance cost if they pay it once a year and have had to rely on the line of credit in order to make that payment. It would cost them an interest anyway. So a lot of businesses do pay it monthly. For the businesses that pay it once a year, there will be a prepaid insurance amount on the balance sheet at year end, unless the payment coincides with the year end, meaning that if it's a December year end, the insurance is paid January 2nd, so right after the year end, and it's used up entirely by the year end. That is a very unusual circumstance. There's usually some component of prepaid insurance. Rent, and this would also include the rent deposit or security deposit. That's another prepaid item. We always want to keep track of that because often the lease agreement is a 5-year or 10-year lease agreement, and we want to make sure that we've captured that on the balance sheet so that when the lease term is done, we have a reminder to go back to the lease agreement and demonstrate to the landlord that, yeah, I paid this security deposit and it's due back to me because I've given the property back to you in good form, or I paid the last month's rent up front. That's normal as well. Might have even paid the last 2 months of rent, and we don't want to double pay the rent. So I always want to make sure we've acknowledged those as prepaid expenses. Occasionally, we would have some office supplies that are prepaid. These days, those are pretty minimal, especially with us moving to so much electronic documents. But this used to include things like letterhead and envelopes and items that we might buy right before year end and not use up until 6 months after year end. Now, intangible assets, this can be a goodwill, it can be purchased tangibles such as client lists, some trademarks that maybe we acquired from a prior owner, or trademarks that we created internally by getting them registered through legal process. It can include patents and copyrights as well. We can also have proven products, so where we've invested in research and development that actually resulted in a proven product. So we can also have that as an intangible. It's a rare item. Usually research and development is just expensed as it goes. But when it's resulted in some proven future benefit, we might also have that. Sometimes the intangible assets are depreciated over time. Other times we don't depreciate them because they only appreciate over time as we grow the business. We will have to evaluate that on a regular basis to make sure. Same with inventory, actually. We have to take a look at the inventory and what comprises it. Sometimes we find that we have something that's now an obsolete good. It either got damaged on our site, or it's just something we purchased and now it's not likely to be used again because the technology has changed. So we always have to be evaluating whether or not these assets truly have value, and where their future value is less than what we've recorded under historical cost, we would have to write it down, write off damaged or obsolete inventory. And also the same with goodwill, damaged or obsolete goodwill. Let's talk a little bit now about depreciation. So accounting rules typically record all of our assets and liabilities at historical cost. We want to deal with the asset side here. We record things at the value that they transacted, not necessarily the value that they are today. So with equipment, we will depreciate the equipment over time. So let's say you buy a forklift for use in your warehouse, and we expect at the beginning that it will last for 10 years. So, and that the other assumption we're going to make in that is that it is used in the same amount each and every year. So it's not, you know, used a lot in one year and then hardly at all in the next year. Instead, we're saying that it will be used equally for, say, 200 days of the year, each and every year. So we would then use probably a straight line method of depreciation for accounting purposes. I'm not going to talk too much about tax because tax puts some very specific rules on how that will be depreciated. A lot of you may be in the small businesses where we, as accountants, will align the depreciation method for accounting purposes to tax basis. But let's use a proper accounting method, which is in alignment with the use of the equipment. So in that example, we would depreciate the equipment over 10 years. When it comes to buildings and land, which we don't have shown on here, we find that buildings and land only appreciate over time. And we will, from an accounting perspective, depreciate the building mostly because we can for tax purposes and claim that expense over time. But what we find is when we dispose of the land and building, that we sell it for more than what it cost, and definitely more than the book value, because we've depreciated the building over time. And what's important to note on that is, from an accounting perspective, we are not constantly updating the fair market value of the land and building. And we can run into a situation where the assets, especially if we've depreciated the building, where the assets now show, you know, a low value. And if we've taken loans out against the increase in the value of the land and building, we can actually show loans that exceed the assets on the accounting financial statements. But we know from a market value basis, the land and building do support the loan value. These are conversations that I have with bankers, or that my clients would have with their bankers on a regular basis if they're using that increase in equity from the market value to finance ongoing operations. So here's an example of a $50,000 dump truck that we know, or we expect at the beginning when we make the acquisition, that it's going to last us 5 years in operations. So we would, and we're also assuming that we use that dump truck equally in each of those 5 years. So we use straight line depreciation. We amortize $10,000 per year. So by the end of the 5 years, it is fully depreciated. This is the accumulated depreciation. So in the first year, we expensed $10,000 to the income statement. Then next year, we expensed another $10,000 to the income statement. But the accumulated depreciation over time is the 2 years of totaling $20,000, and so on and so forth. And that's what we would do with a building as well. Even though the building will likely appreciate in value, that's the usual. I'll say there's a few examples where land and building actually don't appreciate, and that's usually to do with economic conditions surrounding the economy. I'll give one example. When there was a shutdown of some manufacturing plants down in a community in Ontario, we saw that houses that had been acquired the prior year for $300,000 or $400,000 we're now selling for about $100,000 or $150,000 because nobody was moving to the community. There was a mass exodus out of the community because there was no more work there. These are usually temporary because the economy will usually get replaced with something else, but it was this sudden thing that happened, and that can happen. So, but generally speaking, we see only increases in the land and building values, and we will see only reductions in value of equipment just because it gets used up, and we know that used equipment sells for less than what we acquired it new. So let's take a look at some accrued liabilities. Some typical ones are sales tax, so GST or HST, depending which province you're working in. And we can have accrued rent, equipment rent, for example. You can have the accrued accounting fees, any legal fees related to the year end that are also incurred after year end. Often that's to paper in the minute book, the director's review of the financial statements. That's a required documentation each year. And so the lawyer fee, we might accrue that as well. We would also have some accrued wages and vacation. So maybe our payroll was paid only to the last 5 days of the year. So we have 5 days of the current year payroll owing when we look at the year end. So we want to make sure we accrue the wages owing, accrue any vacations owing to people, especially if people have not been taking their vacation and we don't pay them out with each and every pay. And then there's always some payroll taxes because the remittances of CPP, EI, and tax withholdings are not typically due until 15 days after the year end. It can be only 3 days after year end. It depends on what your payroll obligations are. And then we can also have some unearned revenue situations where customers have paid us. Maybe they've paid us a deposit on some work and we have not even started that project yet at year end. So we can have some unearned revenue. So bank loans, bank loans can be a little bit confusing to small business owners, at least when they're first starting out. We want to segregate the current portion of any bank loan out from the long-term portion. So perhaps we've taken a loan of $30,000 to pay for that $50,000 piece of equipment, that dump truck that we saw earlier. Maybe we were able to pay $20,000 of it from our own cash reserves, and we took a $30,000 loan. The $30,000 loan is payable over time. So we would record the current portion of the principal. So this does not include any interest component, any of the interest that we're going to pay. We just expense as it happens. So if $5,000 is what's due in the next 12 months on the principal, then we would show the $5,000 as current and the other $25,000 as long-term. Now, retained earnings. This is one I often have conversations with business owners on a regular basis. It is what it's called. It's earnings that have been retained in the business. So it is the profits that have been made in the business and then just reinvested or held in cash. It is not necessarily available as cash. It depends on how much cash we've retained in the business. Dividend payments to the business owner reduce the retained earnings. Again, it's earnings that have been retained in the business. Once it's been dividended out to a business owner, then that reduces the earnings that have been retained. Now, business owners can be paid in salary or dividends. If it's salary, it's just reduce the retained earnings over time because the salary is expensed. And the dividend just comes straight out of the retained earnings. So here's our combined owner's equity, which includes the original acquisition of the shares and the earnings retained to the end of, in this example, to the end of 2019. Then in 2020, if we end up having a net income after tax of $5,000, that increases the retained earnings. This assumes that there were no dividends that were paid to the business owner. Maybe the business owner only received salary, and so the salary was already incorporated in this net income number by expensing it against the revenues. So retained earnings at the end of 2019 plus the 2020 annual profit of $5,000 makes the 2020 year-end retained earnings be $15,000. So this is the profit and loss statement for the same business. So we have revenue of 200,000. We have some cost of goods sold of 72,000. We have some selling and G&A. So this might be where the business owner's salary resides. Anything that's not directly attributable to manufacturing or making the sales. And then we have this depreciation and amortization. So depreciation being the dump truck depreciation, and the amortization being the amortization of the intangible asset, which was goodwill. So that creates our operating profit of 46,000. And then we have some non-operating activities. So we have interest. Interest is not an operating cost. It is a financing decision. So instead of requiring the shareholders to contribute more capital to the business, we've decided to go to the bank and obtain a loan. And so this is a financing cost, a non-operating cost, interest on the loan. We may have some other revenue and gains. Maybe we sold a piece of equipment and made a gain on it. These are things that happen as a result of assets or some other decisions that the business owner has made that are not related to the ongoing operations of the business. And we might have had a discontinued operation. We found that one of our product lines, just an identifiable product line that we could segregate everything from, and we've said, we're not going to do this anymore. And so we have a loss on the disposition of the assets that related to manufacturing that. So then we have a profit before tax, and then at some kind of an income tax number and our net income. We usually show income taxes as a separate item, and it's usually a component. Just we have net income before tax and then the income tax. This discontinued operation, it's a smaller amount here, so it may not have been tax affected. On larger amounts, we will tax affect it here and then show the income taxes on the ongoing operations here. Now we'll talk briefly about some earnings per share. So even in small companies, it's worthwhile having a conversation about what the earnings per share is, especially when looking at other investments that the business owner might be able to make. Now, it's way more complex than that because a business owner is obviously receiving a salary, and they may not be able to make that same salary somewhere else, may or may not. So an owner manager has two components to their compensation. They have an ongoing salary they're receiving, and then also a return on the business that we can compare that ongoing income from the business as we might be able to compare that to some publicly traded company, not sure. So each share has value, and then we would compute what the earnings per share is. In this example, the owner originally made a $50,000 investment that was comprised of 5,000 shares purchased for $10 per share. Okay, so 5,000 shares times the $10 was their $50,000 investment. And then the retained earnings over time that still exist in the business is 15,000. So we would take earnings per share divided by, in this case, we're going to do earnings per share for the year. So we had net profit of 32,000. We had 5,000 shares that were outstanding. So for the year, we had $6.40 per share, Just going to go back so that you can see where those numbers come from. Here's the 32,000 after tax that was earned in the company. We know they acquired 5,000 shares. So it's the 32,000 divided by 5,000 is the $6.40 per share. We would usually turn that into some kind of a return, so a percentage. So we take that 640 divided by the $10 per share, and we would see that they've got some percent of return. So that we're pretty close to the end. So I've actually got about 15 minutes for any questions that people have. These are some additional resources. In addition to receiving the slides, I think Linda should have a list of the glossary of terms that we've used. There's an implementation checklist on how to implement some of these more complex things in your financial reporting. There is this BDC link, which is to talk about properly measuring your profits. The Business Development Corporation or Bank of Canada, the BDC, has lots and lots of resources for small business owners. I often refer my clients to that, both the long-term clients, ones that have had businesses for a while. We can find some more complex examples. And then there's also a lot of startup information that they have, tons of valuable information on writing a business plan and measuring profit, how to do some marketing, tons of resources there. And then Business Link, who's who is facilitating this presentation today, they also have tons of examples and guidance in that as well. So these are two resources from the Business Development Bank of Canada that you may want to check out. And now I will just field some additional questions that anybody might have.
Thanks, Vanessa. This is sometimes the stuff where people go, oh my gosh, there's just so much here. You can take it all in, but you sometimes have to take it all in a few times, especially if accounting is not your profession. You need to take it in a number of times before you really understand, some of the more conceptual things around amortization and depreciation and retained earnings and some of the stuff that just gets a little more granular. So for those of you on the call who are bookkeepers and work for the company doing that kind of work, this is probably just refresher stuff for you. And for those of us who are business owners like me, well, I've been at it a long enough time, and now I've had a big loan from the BDC, so I understand all the reporting there. I can't say enough about the importance of going to check out the BDC website and all of the reference material, articles, blog posts, entrepreneurial toolkit things that they have there. I worked for 4 years with the BDC as a small business advisor, and I can tell you the resources there are just fantastic, especially if you're sort of over that year hump in your business and you're into more of the 2 to 3 year on beyond. Business Link for sure. If you come visit us, you're going to see more of the start planning resources, but it's all very applicable. I did see a hand raised in a Q&A, so we're going to go. I'm not receiving the link. Okay, if you go over to chat, everyone in chat, I'm going to paste the link again. If you pop over to chat, you'll see a link in chat that allows you to download the handouts directly from the links. Did that answer the question, Deberga, hopefully? Awesome. Okay.
I'm going to mention a few things. So what I've seen, so first of all, the slides are prepared by CPA Canada, and I don't get I don't get flexibility in editing any of the information that's presented. And that's so that these presentations are standardized across the country whenever they're being done. I'm going to make some comments. A lot of small business owners will go to their accountant, and the accountant will use the same depreciation method on the financial reporting as is used for tax. And tax rules from the last couple of years have allowed us to expense assets. And this has resulted in some really questionable things happening, and where the banks have said, hey, we advanced. So Let me give you an example. That dump truck. I'm not sure if it's in the category that can be depreciated 100% and written off 100%. It likely is, though. So you buy the piece of equipment in 2021, and the tax rules say you can depreciate all of it. You can record all $50,000 of it as an expense in the current year. So if you remember, those financial statements showed a $32,000 income. That was with only $10,000 of the asset being written off that year. If we recorded the other $40,000 for accounting purposes to match the tax, we would actually end up with a $18,000 loss. And on top of that, have assets showing of zero. And yet the bank financed 30,000 of it. So then when the financial statements are given to the bank says, hey, we gave you that $30,000 to acquire a $50,000 asset. Where's the asset? It's zero. And on top of that, you've shown a loss. Now we have a lot of concerns about being able to collect the loan. And that was all because the decision was made to make the depreciation match the tax purposes and not the real accounting basis. It's a simple example that's real, that's happened, where accountants have made that decision and the bank said, hey, like, what's going on? I think the right answer is to depreciate the asset over the 5 years for an accounting basis, still take advantage of the tax rule on the tax return, and have this reconciling item between tax and accounting. Us accountants are experts at reconciling the accounting basis to tax. We should be. And so as a business owner, to make sure that you're aware of these decisions that can be made, I like to use depreciation rates that match the accounting for it and deal with the tax on the tax return. That's what we should be doing. We should be, as accountants, supporting that. But these are some things that really do happen. I do have other businesses where it makes much more sense to just use the CCA rates because it doesn't really impact the bottom line. You know, I've got a consultant where they're making $200,000 a year of revenue. They have one computer for $3,000. We're just going to use the CCA rate. But where you're a manufacturer, you've got high capital costs. We want to make the amortization rates match the actual use of the equipment, not just because of tax. Small example, but very real, has happened over the course of the last couple of years where lots of banks have had questions about that, and they've actually raised it as an issue back to us accountants.
It's really important too, as business owners, to have a little glimpse of this on the back end of things and to see into it, because it allows us as business owners to speak the language with our accountants so that we're communicating the same things and on the same page. And you're also not leaving the accountant's office going, what did I just hear? How did this all happen? What's going on here? You know, for a lot of us as business owners, taking courses, short courses like this online, spending time with your accountant on a regular basis, you know, quarterly even, or every 6 weeks or something like that, just to check in and refresh yourself on what some of this stuff is all about, can really go a long way towards advancing your business to another level as well. Because if you now understand the terminology, you now understand why things are being slotted where they're slotted, or why things don't look as good. And that happens to me a lot. Why things don't look as good as you feel they're looking. It helps you plan ahead too. If you want to get some financing, if you want to introduce something new into your business, it helps you understand, ooh, this is how it may look for a year or two before it looks better, or this is how it's going to look to someone else if they're going to want to lend to me, and how do we work with this advisor we have to make sure we're tracking it and being able to communicate to the advisor, to the banker, know what we're doing and make that decision. So I know this stuff can feel very dry for a lot of entrepreneurs, but it's the core. It really is the core of what we can use to make decisions with.
So I have several comments on this actually from the business owner perspective. At no point in time should the business owner feel that they have to be the expert in accounting. They just shouldn't. They're experts in what they do, and whatever industry that is. But you need to rely on the expertise of the accountant and allow yourself to be educated on a few things about that financial reporting. In addition, when so many of the business owners only have their year-end financial statements and they don't have projections, and they're not forward-looking. I have two businesses. I have this professional corporation that I've given you the link for, where I do a year-end for people. But I have another business that's a fractional controllership or fractional CFO service business. And there are a lot of businesses out there that specialize just in that aspect. And they're helping with the strategic vision. They're helping with projections of the business. So forward-looking information. The year end is all historical cost. It's something that's required to get the tax returns done. But there should be some understanding of why those statements look a little different than internal projections going forward, that's based on assumptions being made about the economic environment, about pricing, about sales, and about the expenses that are going to be incurred in order to get there. And particularly when a business is in growth mode, you need those projections for a minimum of 2 years looking forward, because in growth mode, there are a lot of costs that are incurred to get those additional sales revenues, and often paid for before the sales are made. So there are cash needs in order to advance the business. So an example in my own industry is that I have to pay my employees as they do work. So if I bring on a new employee to support a bunch of new clients, I'm paying that employee as they do the work, and then getting receipts from the client, 2 to 3 months later. So I need this interim financing that happens to fund the incurrence of those costs. If you're a manufacturer, you have the upfront cost of the capital equipment, then you have the production cost, and then you invoice when you've actually sold the good. So again, you've got short-term cash needs. You need to plan for that so that the pricing of your product, when you finally sell it, will be adequate to support all of those costs that you've already paid. These are internal financial reporting that needs to be incorporated into the business, not just the year-end information that we've talked about.
Thanks, Vanessa. I know you have so much great insight into just sort of practical day-to-day of this stuff as well. So thanks for what I love about your presentation is you're sharing a story, you're sharing examples. It can make it very real to some of us that don't see these things on a reality basis. So thank you for doing that as well, just going a little bit beyond what the numbers are and talking to us a little bit about what they do for us and how you see them and how they're used in a business. So I really appreciate you taking the time to do that today. It looks like we don't have any more questions. I think everyone's taking the information in and going, phew, we need to review it again. So for those of you, we'll do a follow-up email to you to thank you, send you a short survey. This webinar is also getting posted to the Business Link website in the next 2 to 3 days. So we'll make sure that gets posted, and you'll be sent the link with the email I send out to everyone, thanking them and sending you a survey and sending you a link to the posting of the recording as well. So you can always check back in on this one as well. Thanks, Vanessa. Thanks, everyone. It looks like we've ended a bit early. I'm a-okay with that. Getting to lattes is a wonderful thing for me to do, and I'm sure everyone else is happy to do it too. So wanted to say thanks again. Looking forward to seeing maybe some of you next week at the next presentation. Vanessa will be here next week presenting. And take care. Everyone have a wonderful afternoon.
Thanks, everyone.